Hello, everyone. Welcome to video 5 of chapter 6. In the last video, we finished talking about the reserve concept, the tax rules that allow taxation, which is normally cash-based, to kind of imitate the accrual methods that we commonly see in accounting principles. In this video, we're going to look at limitations on deductions. So the thing is, there's a difference between what's allowed to be deducted in our accounting financial statements and what's allowed to be deducted for taxes. So there's certain deductions that may have been taken on a financial statement that aren't allowed, or at least are limited in some way. So when you're compiling your financial statements, it's important to note what expenses are you using and earmark those that will have some sort of limitation on the tax return so you know which ones to adjust. So it's important to identify which expenses have been claimed as a part of profit, Tax Act 9, that are acceptable and those that are not. And then we will review Tax Act 18 in this video, showing certain tax sections that are blocking the ability to deduct certain expenses. And then in the next video, I will talk about what expenses are allowed or specific deductions that sometimes can take the place of limited deductions or can be used or calculated to take expenses that might not apply to an accounting standpoint. So the general rules when wanting to deduct any expense is the expense needs to be connected to an existing source of income and must be incurred for income earning purposes. If I'm buying something not to make money, then I'm probably buying it for my own benefit or the benefit of, friends and family. So since I'm consuming that item, I can't deduct that expense from my income because it's not associated with earning said income. It can be a capital expenditure, but only if allowed by the Tax Act. Expenses cannot be personal. Amount claim must be reasonable. Reasonable is an idea in taxes that it's understood that certain expenses are necessary, but paying luxurious amounts for it are not. I need a function to be set, but paying too much for it might be unreasonable. For example, let's say I'm going to a convention and there's lots of people there from other industries, other businesses, and we're having a networking event. We probably need to stay in a hotel. Now, most of the people there are staying in just an overnight budget hotel, $100 for the evening, but I want to go somewhere nice. I want to get a hotel room that's, you know, $900 a night, and perhaps it has some in-room service, perhaps a spa treatment. Those expenses are not related to the business function. Those are so I can enjoy myself while I'm there. So the CRA say, well, having the stay the night is reasonable, so you'll be allowed to expense a reasonable amount of the hotel stay. So if it costs $900, but generally most businessmen will have, or business associates will be paying 100 to 150, then perhaps we're only allowed to expense the 150. The unreasonable portion will be denied. So, and anything not otherwise prohibited by a specific Income Tax Act provision. So we might have expenses that do relate to a source of income, are for earning income, but are specifically denied by the Tax Act. Capital expenditures are items that could be expense, but if they relate to an asset, we'll include it in the capital cost. But generally, the idea is it must be related to earning income, it can't be for personal benefit, and it must be reasonable. So let's go over some specific limitations. The next few slides are generally me just listing off some of the deductions. So if it goes too fast, feel free to slow down the video or just go over the slides yourself. These are listed in the textbook with more detail, so feel free to review that there as well. So we must ensure expenses are sufficiently connected to a source of income that is business or property. How they adjudicate this is, would the expenditure have been incurred if the absence of the business or property? So if I have a construction business, I might have some safety expenses, some high visibility vests that everyone has to wear. If I didn't have that construction business, would I be buying safety vests? Probably not. So the expenditure is tied to the business because if I wasn't in that business, I likely wouldn't be purchasing that item. Motivation or intention of expense is to earn income, must have the capacity to earn a profit. So they'll take a look at your activity and they'll say, mathematically, is it even feasible for you to earn a profit? If your revenues are too low, if your customers are too few, if you cannot functionally even earn a profit, then how can we allow you the expenses? Obviously, your motivation can't be profit motivated if profit's not possible. There's no personal element, and examples are recurring business expenses. So recurring business expenses are day-to-day expenses such as office expenses, administration, rent for a space, salaries for staff and assistants, advertising. So these are, if I'm advertising my product, that's not for my benefit, that's to garner customers. Yeah, now, capital expenditures. So, Tax Act Section 18, 1B, there's no deduction for capital expenditures. If a transaction is considered to be capital in nature, likely you're purchasing an asset or property for earning income, you can't deduct it right away. This is the section that says you cannot deduct that expenditure, that expense. It has to be included in the cost of whatever you acquired. So, cost to acquire the property, cost to create business structure or add or acquire existing business structure. Business structure sort of being the administrative process or the functional process to produce your product or service. So my business structure, if I print logo t-shirts, I'll have machinery. I'll have a place to do the printing. I might have a section where packaging occurs. These are our business structures to facilitate raw materials into our finished and delivery of product. Income Tax Act 20 may contain specific provisions that allow deductions of capital expenditures. Tax Act Section 18 is where it says you cannot expense capital expenditures, but Tax Act 20 is where it says, okay, but you can deduct a portion of those expenses through CCA. Or there's certain transactions that may be capital in nature that you are allowed to deduct fully. For personal living expenses, there's no deduction for personal or living expenses because that's for your benefit. I live in my house, I pay for my house because that's my shelter, that's where I spend my time in my life. So this often relates to our principal residence. If you have a cottage or a vacation property, that's for your benefit and your pleasure. Life insurance premiums. You'll often have life insurance premiums paid by a business, especially for main shareholders or executive level personnel. Main shareholders mostly in private corporations. So if the company is paying life insurance premium and the beneficiary is the executives, their families, that's not deductible. But if the life insurance is required for financing, which we do go into in a later slide, then it is deductible, especially if the beneficiary is not the individual, but the bank to cash out certain loans or mortgages. So if the bank requires the life insurance, it is deductible, but most other life insurance premiums are not. So expenses not connected to any source of income are considered to be personal in nature, since these items, my own house and a vacation property, are for my purposes or my, luxury or pleasure. It's not associated with the actual earning of income and thus cannot be deducted. There's no deduction for amounts incurred to maintain yacht, camp, lodge, golf course, or facility dues. So membership fees are dues to any club, the main purpose of which is to provide dining, sporting, or recreational facilities to members. It is a big perk or benefit that a lot of corporations will pay for, let's say, golf memberships, especially for their executives teams. And they say that, deals are made on the golf course. A lot of high-powered, very wealthy business associates will have memberships at golf course, and they'll use those memberships to meet up with other individuals and associates, and they will play together. And spending that time, they'll talk about deals. So a lot of corporations would say we need to pay for these membership dues because it's required to make our deals. But it's a very luxurious expenditure, and these club fees can be hundreds of thousands of dollars. And when you're paying for an executive team, they could be millions or tens of millions of dollars every year. So allowing these corporations to pay such exorbitant amounts was seriously reducing the tax revenue. So eventually, the government came in and said, okay, you know what? If you feel it's necessary, feel free to keep paying the dues, but you can no longer deduct them for tax purposes. So it's an expense that might show up on a financial statement, but it cannot be claimed on a tax return. Other limitations, safety deposit box fees cannot be deducted. Political contributions, no deduction for political contributions. This, we discussed political contributions in chapter 4. There's limitations on how much a person can contribute because they don't want one specific wealthy person to significantly sway, political campaigns or election outcomes. And on that point, they also want to limit corporations' ability to do the same. So corporations are not allowed to claim deductions. Corporations cannot claim deductions for the political contributions they make. Lease cancellation payments. So if you have a lease in place and you cancel it, there might be a lump sum you have to pay to cancel that lease. So the rules in the Tax Act say if you pay that lease cancellation payment, you will deduct it over the course of time the lease would have taken place. So you don't get the deduction right away when you actually make the payment. You'll be able to sort of amortize that payment over time or over what would have been expected the remaining lease time. There's certain automobile allowances. In chapter 3, we noted that if your business or if your place of work, your employer is paying you a set rate per kilometer to use your own vehicle. To use my vehicle, it's a certain amount of gas, a certain amount of maintenance and wear and tear. So um, they have this guide number to say a reasonable amount to be paid is 72 cents for the first 5,000 kilometers. So if I'm using my own vehicle, my employer can pay me 72 cents per kilometer, and I don't have to report it on my income because that's considered to be a reasonable reimbursement. So if I'm allowed to keep it off, it's considered reasonable, so I don't have to include it on income, it's also considered reasonable for the business to expense it. Since this is declared to be a reasonable rate to pay your employees, surely it's acceptable to deduct from your income. Now, if they don't use the rate, if the employer just includes a monthly allowance and they say, we understand you have to travel, here's $1,000 a month, make it work, the individual will add that allowance to income entirely, and then they will deduct the specific expenses for their work travel. If you're paying an allowance as the employer, you get to deduct the full allowance. Since it's going to be included in that person's income, the corporation or business can deduct it fully from their business income. Payment under the Tax Act, no deduction for amounts charged for federal income tax, interest, and penalties. Basically, any amounts that you have to pay the government for amounts owed for taxes or penalties, you cannot deduct from income. If you were allowed to deduct income tax, you'd figure out your accounting income, find your taxable income. Oh, now I pay taxes, but that tax should be accrued. So that's going to reduce your income, which would then reduce your taxes, which paying more taxes would reduce your income. And it creates this circle where it's continuously going down. So federal income tax is not a deductible expense. Your taxable income is set, not including that tax amount that you need to pay. That being said, interest and penalties are also not deductible. The government does not want to incentivize people not to pay the government. So they don't allow interest and expenses for any amounts owed to them. If I'm paying interest and penalties to a supplier, that can be deducted, but amounts to the government cannot be. Interest in property taxes on land, limitation on deduction for property tax and interest on land, if not used in the course of carrying on a business, is not a source of income primarily acquired for purpose of generating profit. So perhaps we have a space that's not earning income. We've bought some land and we're not quite using it for business yet. then there's a limitation on the property taxes and interest. We can't deduct it from income. I will say in this situation, normally businesses will take the property tax and interest paid and roll it into the property, into the land, especially if they're planning to develop the land later. So they'll kind of roll that continuous cost until the land is built upon or is developed. And then after that point, they will be able to deduct the property taxes because now it's associated with the business operation. Um, the deduction limited to amount of gross revenue less all expenses not including property taxes and interest. This amount cannot be used to create or increase a business or property loss. So even if they do allow the property taxes to be deducted, you cannot generate a loss with it. So mostly it would need to be either a minute or small amount, but that's only able you're only able to do that if you have some sort of revenue generating purpose. So let's say my piece of land is my parking lot. So my parking lot, I'm charging parking fees. So it is generating revenue. Now the property taxes and interest can be claimed, but I can't declare a loss from the parking lot. Um, Excess property taxes and interest, I said before, are generally added to the cost of land as non-depreciable capital property. Exception for corporations whose principal business is leasing, rental, or sale, or the development, lease, or rental or sale of land. Basically saying, yes, there's this limitation on what you can do with land or what you can expense from it, unless your business is renting land. Perhaps I have a section of land that I rent out for outdoor wedding venues. Perhaps I have a section of land that I rent to a nearby farm business. They rent my land so they can extend their harvest. So I might have certain expenses for that business related revenue. So if your business is that piece of land, then yes, these limitations don't quite apply. But if my business is printing t-shirts and I have a piece of land that I'm not doing anything with yet, then this limitation applies. Soft costs, costs attributable to a piece of construction, renovation, or alteration of a building. While a building is under construction, it's not ready for use. So soft cost generally relates to those legal costs associated with maintaining the interest, legal, accounting fees, insurance for that piece of property. So those would just be added to the cost of the building while it's being built or renovated. So while I do not have access, while that building's not ready to be used, while it's not being depreciated, the soft cost will not be deducted from income, but incorporated into the cost. Prepaid expenses, no deduction or outlays for expenses paid in current year for goods and services delivered after year end. So this applies the matching concept. When we were discussing reserves, if I collected money, but I haven't earned it yet, I have a reserve. I deduct from income that money received but not yet earned. In the same vein, if I've paid money up front for an expense that hasn't occurred yet, I cannot take the deduction. I can't subtract it from my income yet, not until that money's been earned by my supplier. So this comes into play because of the matching concept. One of the most common thing is when companies pay for insurance. Sometimes they'll pay for the whole year up front, but if only 4 months have passed, you can deduct 4 months of that insurance, but that prepaid portion that goes until next year cannot be deducted. And here we'll finish up with business use of home office expenses. Now, it's very common that small businesses that are just getting off the ground might not have a designated work office space. So people run that business out of their garage, their basement, maybe from their dining room table. Expenses are limited where a workspace is situated in a home in which the individual lives that is used for the taxpayer's business. So the difficulty here is you cannot deduct personal expenses, but you can deduct business expenses. So the question is, if the business is operating in the home, how much of those general home expenses that are normally personal can be deducted for business? Workspace expenses cannot create or increase a business loss. So I can't take a business loss in the first few, let's say I have a new business, I'm trying to get it to grow. those work, if I don't have the revenues high enough yet to allocate all of my workspace expenses, they will sit on my tax return and I can claim them against future income if my business starts to grow and earn profit. But I cannot create or increase a business loss using home office expenses. So in order to claim a home office expense, it must be the principal place of business. I just run it out of my basement. There's my business. Let's say I have an Etsy shop that, you know, um, I have an Etsy shop. I sell small craft items that I package in my basement and mail off. It's used exclusively for earning business income and used on a regular, continuous basis for clients, customers, or patients of the individual. My most common example for this is realtors. Realtors, most of their business is out showing people houses, but they might have a meeting space in the front of the house where they actually meet clients. So that small space can be used if it's used regularly and continuously for clients. If the workspace is not the principal place of business, it requires that some part of the home be designated as the home workspace and not used for any other purpose. Maybe my Etsy shop, I package those orders in a small warehouse, but the office activity, my accounting for staff, where I handle my taxes, my calculations, my bookkeeping, where I take my calls for dealing with suppliers or customers, that office space could be in my home. So my principal place of business is now the warehouse. But as long as I designate, perhaps this room, I designate this is my home office space. If I only use that room for business, then it's a home office and I can claim expenses. If the workspace is the principal place of business, then the workspace does not have to be used exclusively for business purposes. So on the one hand, this room has to be used for business. But if this is, let's say, you have your dining room table and that's where you package your Etsy orders. So that dining table my family uses every night to eat dinner, and only during the day do I have a whole bunch of packaging and a whole bunch of product laid out, and I wrap them and I put a label on them and I mail them out. Because I don't handle my business anywhere else, that's fine. It is my place of business during the day, and I use it for my personal functions at night. So we've designated a business space in our home. So how much can we deduct? Well, you have to figure out a percentage. We take the dedicated workspace divided by the finished livable space. So if my house is 1,000 square feet, my designated workspace is say 100 square feet, that's 10%. If my workspace is 10%, then I can take 10% of the general home expenses, the heat, the hydro, general maintenance. Since those expenses are for the whole house, the portion of it that relates to my workspace is deductible. So expenses are a portion between personal and business. The CCA is not generally advisable. If it's your business, you can take CCA, but your house is your principal residence, and principal residences are protected from capital gains. So if you take CCA on a business portion of the house, it significantly complicates that principal residence exemption. So we generally do not advise that you take the CCA, but you are allowed to. Here's just a chart on the deductibility of certain home office expenses. Now, if you are an employee that a regular employee earns no commissions, you're very limited in what you can claim. You have your rent, your utilities, and your general repairs and maintenance. Telephone and internet is more complicated because if you have a home phone and you have internet access, it's very complicated to portion. Yes, that's for the business space. It's hard to say 10% of my internet is for business. Because if I'm streaming shows at night, I'm using way more data than a couple of spreadsheets and phone calls during the day. So it's not really supplied. So the base subscription fees are often not allowed to be deducted, but if you have additional charges specifically for business, then those can be deducted. So regular employees have the most limitations. Employees with commissions, it's recognized that sales individuals have more reliance on personal expenses to get sales. So they're allowed a few more options. They can deduct their municipal taxes and their home insurance. If you're running a business, you get the whole gamut. You can expense anything as long as it's related to the portion of your business. So you can take a portion of your mortgage interest, and that's when you can take CCA on your house if you'd like to. So let's go to the exercise for it. During the current year, Yobel Chris has the following workspace expenses. So we have a series of numbers here for utilities, maintenance and repairs, property tax, house insurance, mortgage, repainting and rewiring of the workspace of the home. If there's a general maintenance expense, let's say my workspace is 10%. If I have a general maintenance expense, like I replace the roof or I do some rewiring through the house, I can take 10%, the business portion, and expense it. If I do maintenance specifically to the work area, well, now it's fully deductible because it's all business. If I take an expense and I renovate the kitchen's not associated with the business portion, so I can't expense any of it. So general maintenance, we take our part. If it's specifically for the workspace, you can take all of it. And then home internet access and home telephone, we have specific business related charges. So Mr. Chris is a workaholic with no family, friends, pets, or personal interest. He estimates that he uses 25% of his residence, including common areas, and 95% of his home phone and internet for employment business related purposes. Maximum CCA on 100% of the house would be $12,000. Determine the maximum deduction that would be available to Mr. Chris, assuming, and the three cases is he a regular employee? Is he a commission employee? Is he running a business? So I don't want to take too much time going through the list. This video is getting on the long side. So I've put the expenses into this spreadsheet. The home telephone, the basic charge is not deductible, but the business related long distance, because it's specific for business, is fully deductible. The home internet services was 960. It's assumed the business rate is 95%, so we can take that amount. The reason I'm emphasizing these two is if you get a question about the home office expense, we will give you these percentage portions to figure out that home internet charge. Remember that for the telephone, the basic charge is not deductible, but business related is. The rewiring of the workspace, because it's specific to the workspace, there's no modification, it's going to be deductible. So these rates are probably not going to change all that much. What is going to change are these general expenses up here. We're told the house is 25% for business. So if an expense is allowed, we will take 25% of it. So employees with no commissions have a very limited list. We just get the utilities and the maintenance. We would be able to portion some of the rent, but Yobel owns his house, so he has mortgage interest on mortgage. So these first three is for employees with no commissions. If we change this to an employee with commissions, now we have the addition of the property taxes and the house insurance, so we get to take a portion of those. Originally with no commissions, our total expenses was just over $4,000. Commission employees in the same situation have almost $6,000 of total expenses, so they can claim a bit more than a regular employee. A business gets the whole gamut of potential expenses, so now the business can take 95% of that basic charge. They also can take the interest on mortgage and the CCA, and those would relate to 25%. So CCA was $12,000, 25% is $3,000. So portioning out all of those expenses, plus our workspace rewiring, plus internet and phone, 11,447 is what we've come up to. So we started at about 4,000 and now we're halfway through 11. So that's almost $7,500 difference between the two types of employee business expenses. So a self-employed business might have $11,000 available to them. If they don't have the income to claim the full 11, let's say their income was only $7,000, that remaining $4,000 would sit until next year where it might be able to be claimed then. But next year, we'd likely have additional home office expenses, so it can accumulate. Okay, we're just short of 30 minutes, so I'm going to stop it there. This video talked about deductions that were limited. Next video, we'll talk about deductions that can be claimed. Thank you for your time. See you in the next video.